Hello everyone, and welcome back to Simply Finance. If you are looking to get into stocks and investing, why not take advice from the pros? Peter Lynch is a world-renowned investor and has a 3-rule strategy that makes sure he gets a return on his investment. If you're not sure why you should trust Peter Lynch's 3 rules, then listen to his short backstory. In the early 1980s, Peter Lynch was a young portfolio manager who rose to prominence as one of the world's most well-known investors. And with good reason. When he took over the Fidelity Magellan Mutual Fund in May 1977, his first position as a portfolio manager, the fund's assets totaled $20 million. Between 1977 and 1990, he turned it into the world's biggest mutual fund, outperforming the industry by a staggering 29% per year on an annualized basis. Lynch wrote several books detailing his investment strategy after his impressive track record as manager of the Magellan Fund attracted the kind of mainstream exposure that normally comes with great results. They're excellent reads, but his central argument can be summarized in 3 points. His first rule is to only buy what you understand. Our best stock analysis instruments, according to Lynch, are our eyes, ears, and common sense. Many of Lynch's brilliant stock ideas came to him as he was going to the grocery store or simply conversing with friends and relatives. When we watch TV, read the newspaper, or listen to the radio, we all have the chance to do first-hand research. When we're walking down the street or on holiday, we should be on the lookout for potential investment opportunities. After all, customers account for 2/3 of the country's gross domestic product. To put it another way, the majority of the financial market exists to serve you, the individual investor. If anything appeals to you as a consumer, it can therefore appeal to you as an investment. Moving on to Peter Lynch's second rule, which is always do your homework. First-hand findings and indirect facts are excellent starting points, yet these brilliant theories must be backed up with sound study. Don't be fooled by Peter Lynch's homey demeanor when it comes to doing thorough analysis. It was a hallmark of his success. Lynch outlined some basic principles that he expects to be met with any stock worth buying while following up on the initial spark of a brilliant idea. His first principle is percentage of sales. If you're first drawn to a business because of a product or service, make sure it accounts for a significant enough amount of revenue to be meaningful. A decent product that only accounts for 5% of sales would have only a minor effect on the bottom line. The second principle is the PEG ratio. This valuation to earnings growth rate ratio can be examined to determine how much anticipation has been developed into the stock. You should look at businesses that have high earnings growth and fair valuations. A strong grower with the PEG ratio of 2 or more already has that earnings growth baked into the stock price, leaving no space for error. The third principle is favor companies with strong cash positions and below average debt-to-equity ratios. Strong cash flows and cautious asset control allow the group flexibility in all business conditions. Now onto Peter Lynch's third investing rule, which is invest for the long run. Peter Lynch himself said, markets are pretty predictable over 10 to 20 years if there aren't many shocks. You should probably toss a coin to see whether they'll be higher or lower in 2 to 3 years. It may come as a surprise to hear those words from a Wall Street hero, but it demonstrates how much he believed in his own ideas. He kept up his experience of the businesses he owned, and he didn't sell as long as the story didn't improve. Lynch didn't want to time the demand or forecast the economy's overall course. In reality, Lynch once conducted research to see if market timing was a viable tactic. As per the study's findings, an individual who spent $1,000 a year on the absolute highest day of the year for 30 years, from 1965 to 1995, would have received a compounded annual gain of 10.6%. If another person invested $1,000 per year on the lowest day of the year for the same period, he or she will receive an annual compounded gain of 11.7% for a 30-year period. As a result, the first investor just trailed in his gains by 1.1% per year after 30 years of the worst possible market timing. As a result, Lynch argues that attempting to forecast short-term market volatility isn't worth the effort. If a corporation is successful, it will make more money and the stock will rise in value. Lynch was able to concentrate on the most critical job, discovering better businesses while making it straightforward. Well, that about wraps it up for today's video. Peter Lynch's track record and stock picking prowess speak for themselves. He mastered the art of learning his surroundings and comprehending the world as it is and as it could be in the future. If you enjoyed, make sure to give this video a like, subscribe, and hit the bell for more finance videos.